S&P 500 holds a critical level. Why the bond market took two massive swings this week and how it affected equities. Financials held the 55 SMA, but what it means going forward. Semiconductors closed at an all-time high close and why this move may not be done. The Nasdaq TRINQ hits a level only seen 5 times in the past 20 years. How a spike in inflation is wreaking havoc on real estate. Nasdaq's record earnings due to NVDA and what that means for the entire market. Composite PMI hitting a 2-year high, spreading fears of inflation. Probabilities of a rate hike are starting to spread again after a recent release of economic data. New York Stock Exchange margin debt continues to grow and why that's helpful. I'll revisit the Zweig breadth thrust and its significance. We have a ton to go over. Let's get to it. Hey everyone, welcome back. Well, we have a lot to go over. First and foremost, the S&P forming a doji, which really shouldn't surprise everybody with the mixed data. What I do want to point out is that we're looking at a weekly chart here, and we are holding that 22. Now, this is a 22, this is a 12, and this is a 55. They are simple moving averages, and this is what I use. You should use what you're comfortable with. We need to start going back and taking a look at some of the older videos and some of the stuff that we did there and how that's related to what just happened in the market and really how that has been telling us how this is going to play out. And nothing makes this cleaner. We're just going to look at the simplest of charts on the weekly. You have a doji right here, and we're looking at moving averages. But if you go back to some of the other videos that we've done, it explains the movement that's going on here. So we're going to connect a bunch of the dots and get really actionable this week. And I appreciate your comments about these videos and using this app versus, this is the TradingView app, versus using just before how we were doing it. I can get a lot more information packed in here for you. But this is going to be a pretty actionable video for everybody. So if you're looking for, okay, I watch this, what do I do with it? We're going to connect all the dots so that you can understand this. And this is based upon your comments saying, hey, could you connect more of this together? We're going to do that. So Nasdaq weekly, right up here, very clear what's happening. Hopefully you see the difference here between the ES and how we have a doji here on the weekly and how you see what's happening here on the Nasdaq where you have an all-time high close. Now, there is a distinct difference between what's going on in the market. So let's just look at this one more time. And you can see right here how you have a doji and you were not even able to make that doji what? Green. It was red. Whereas here we have a higher high and a breakout. So we are seeing a change. And this is actually a bullish change for the market. Let's be very clear about that. It is bullish if we have the Nasdaq lead. That's what you want. You always want the Nasdaq to lead. You do not want the S&P to lead. And we know why we saw that change. And we're going to talk in the S&P. It looked like that might lead for a little bit, and we're seeing the change of that. But this is significant, and it's got more to do with just NVIDIA's earnings. So we're going to talk about it in some detail. But let's review what happened on Thursday and Friday so that you can understand what the heck's going on out there. Now, once again, this is going to be packed. So what I would really appreciate is if you find value in this, not only your comments on how these videos can be made better so that you can get more information to have more ideas, but also I want to get to the point where anything or any feedback you want to see, like I got a bunch of comments on this particular chart. That helps me present data. For example, when people don't understand why we moved at this particular time, those of you that are either in the community or the majority of people just publicly that watch these videos, you should have a clue because we go over this not only in the public pre-market live, but we also go over it in the daily videos. And you're going to see how I'm going to tie this all together today and how it's going to link the videos that we've had in the past weeks. It's going to all tie together so that you can kind of see and go, oh, okay, this is why he keeps saying watch these videos 2 or 3 times and mark them because there's key events in here. So again, on Thursday, we saw the global PMI flash number, and this is a composite, and S&P Global is not ISM. So there are different organizations, and one is considered the gold standard, and then one would be considered not the gold standard is the best way I could look at it, right? Gold or silver. Think of it that way. People would prefer gold over silver. That's ISM versus S&P Global. It's just a very easy way to explain it. Well, what we did previously was just explain that this level of 50 is important. So if you have a level and that level of 50 is your demarcation line, and then what it means is anything above that demarcation line, for example, anything that goes higher to up here, right? Anything up here is going to get us to a point where we have expansion. Now that expansion from here, let me just use that as expansion. Anything that gets you as an expansion up here, right, to that 55, anything over 55, just rule of thumb on ISM of this number, composite, is considered it's almost like a de facto rate hike. Okay, so like you shouldn't be shocked if you're over 55 and the Fed previously would raise rates. This is a very different environment because this Fed loves itself, and we constantly hear them talk every hour about the economy, which is just absolute insanity. It's not supposed to be that way. It's very frustrating for us as traders. But if we take a look at what you're supposed to see here, anything here means we're expanding, and we're expanding so hot that they have to cool the economy down. And then anything from 50 down through here to 45 is contraction. Under 45, you're in a position where you would expect them to do what? The exact opposite of what you would do here, which is cut rates. They're almost de facto to an extent, like, oh, we're under 45. Yeah, they're probably going to cut. We're seeing none of this on that data. So this data that came out is referred to as hot data. Now, I'm not going to get into the graphs for time's sake, but if you went and looked at this data right here, you will find out that it was March 22, which was the last time you had data that hot. And this is through the roof. So when you start seeing these kinds of numbers, global services PMI flash at 54.8 and you're at 54.4, a lot of people are going to look at that and not understand it. And this is why the majority of people don't use things like the stool and don't understand that when they're looking at a chart, they don't understand what happened. They don't understand, the macro, the fundamental, and the technical side of the market, right? They're looking at one side and they have no idea which leg they're leaning on. That looks pretty bad, but draw it out a little bit that way. I don't know if I made it worse. But what you want to do is you want to focus on the macro leg, and then you want to focus here. And so really what this is telling us is, what's happening, who's infected by it, and then when do we act, right? So what's actually happening in the economy, who is affected by it, and when do we act, right? So that's how you look at that. You look at the macro, the fundamental, and the technical. That's how I look at those legs. Now, we can also have another leg later that would be called, human behavior. But if you take a look at this would tell you like, hey, we're hot, okay? So what's going on? We're hot. And by hot, meaning like this is an outsized number. So that is why on Thursday, we did this. And that's a very important concept to get, because I would tell you 90% of the people that you're trading against, if you look at this as you're playing a game and you're competing with people, 90% of the people that you're playing against at least had no idea these numbers are coming out. The other 10% has no idea how to read them. So if you just get this one concept from this video and you understand this, and you set up a simple chart like this, which anybody can do on TradingView for free, which is, this is just the 10-year, this is the dollar, and this is the S&P. And then all you do is just kind of come over here and just mark that 945, and you can see what happened that day and how we fell off. The dollar goes up and they sell bonds. Why do they sell bonds? The chances of a rate hike went up. A matter of fact, if we look at the CME tool and see how that played out, we can see that July, and this is kind of crazy, but they put this back on the table. Now, is there going to be a rate hike? And for those that don't know, this is the CME Fed tool. Anyone can go there for free. You can just type that into Google. But what is this telling us? Well, this is where rates currently are for Fed funds. This is the chance of a rate cut by July, and you could click on any of these to see. So this is telling us again, this is our current target rate, and there's an 89% chance we're going to stay there, and there's a 10% chance of a rate cut in July, and there is a 0.8% chance now of a rate hike in July. This is what happened on that day. Okay, so I take screenshots of economic data events, and then you can see the date down here, kind of. But because I want to see how it affects how people are thinking about the world. This is something that is not great. And you can see it right here that it was not out there a month ago, it was not out there a week ago, and they just dropped the hammer. So all of a sudden, rate hikes were on the table. Why is that important? Because that's why they sell bonds. Because if rates are going to go higher, their bond prices are going to drop. Remember, if you own a 10-year bond and it moves 1%, that's a 10% move against that bond price, right? You just take the yield times the duration, yield times duration, okay? And then that'll give you the bond price move. Back of envelope way to do it. So just a side note, I could spend more time on that, but you should be able to get that concept, 1% times 10, 10% bond move. And then of course they're always levered, right? Because why not? And then what will happen here, yield goes like this, the dollar will go higher, equities will drop, right? Yield goes higher, the dollar will rally, equities will drop. Okay, this is just standard way that macro works. So when people are trading the zero-dated options, if they don't know this stuff, they're playing against the most disciplined people, smartest people in the world. It's crazy. And they're not aware that this is what's going on. This is when you would do your zero-dated option trades if you're looking at doing that kind of stuff. And you could overlay it with the tick. I could do a whole video on that, just that whole concept. But Then you have Friday, and this is really what is shaking people. And so what we're going to do is just take this off for a second. I just want to point something out because it's significant. So if we go to this date when this happened, we go 9:45, and this is where we're at. And what we're going to do is just mark the S&P from that date, because look at where the S&P is from this date, and look at where you're at on that particular time, and how we did not, right, get back to that level from here. This is significant. Stay with me. Now, on Friday, we had other economic data come out. That economic data, durable goods orders. So durable good orders, then the way to look at that is to think about things that you're going to buy. I always try to say washer and dryer, but it's more than that. Is somebody buying a caboose? Is somebody buying an airplane, right? It's much more than just the washer dryer, but I think that ties it in. So what was really important about this is the economy slowing? And if the economy's slowing and rates are going higher, then we're going to have stagflation, which is now the new buzzword that you're going to see a lot of, right? And what stagflation means is that if you have this whole area like here, what that would mean is that prices are going to go higher and higher, but from the services numbers, but that we're not going to make any more money. And so it just becomes it becomes a pretty much worst case scenario. It's actually worse than inflation, because at least with inflation, you have the income kind of going up, but stagflation, we're all kind of hosed, for lack of a better term, right? Nobody wants it. It's like a worst case scenario. But what's important about this is if we take a look here, here's the actual, here's the consensus. So we were looking for a decrease in durable goods, people buying their new washer dryer, their dishwasher, a firm buying an airplane. I'm just going to say the word caboose again because I want to. And then what you do is then they break it out by X transport. Why? Because not everybody's buying a train engine. Not everybody's buying something along those lines, right? And so what you would do then is you get this X transport number right here, and you can see that that's higher. And this is actually, to me, more significant than this. But this was obviously a huge move, and you can see that. And then, of course, the other thing that they do is they will take out X defense. So they'll remove defense from it as well. And you can see that, and non-defense orders, and they'll take that out as well. But this is really what we want to focus on for durable goods. But the real move came later. Now, Michigan consumer sentiment, what's important about this is how the consumer feels about the world and says, hey, this is how I feel. These are my feelings, for lack of a better term, all right? And so are you going to go out there and buy that new Vision Pro headset? No, because you want a girlfriend, but you still might buy iPods or earpods for your head. You might buy a new iPhone, something like that, right? So when you connect those dots, this tells you how much you're going to spend, and they equate it. Now, and they come up with a number. So here's the consensus, and here's what you came up with. This was previous. Now, for our purposes, this is a awful, awful number. I did a whole study on this, and I did it about a month ago where I showed you what this actually means, but it was better than expected. So what we're seeing is, okay, the consumer is better than expected. We can go look at the XLY names and what's going on there. That's significant. The consumer is better than expected. How does the average consumer feel about inflation and where inflation is? Well, we think that this is significant. We feel we're at 3.1% inflation. Well, over the next 5 years, we really feel like we're at 3%. That's a big deal. And that's one of the things that really affected us. Okay. The other was down here, the final expectation. And that came in at 3.5 versus 3.3. So what this told us was, even though services are hot, which we saw earlier, I personally think services are hot because we're in a service-driven economy. The current people that are out there right now rather have services. They'd much rather have services than things. It's just pretty obvious. So we saw that hot, right? Meaning bet way, way over where we were. And then we tie that to, hey, they're actually buying the washer dryer. Hey, companies are actually buying the airplane. They're buying the caboose. Get it? So this is why we rallied. And then at the same time, yeah, things are pretty bad, but I still want my new earpods. I still want my new iPhone. I still want some things, but not as much as I did, but I still want some things. And yeah, I do think inflation's getting a little bit better, and I do think it's coming down. So despite what you're seeing on TikTok, this is actually worth paying attention to, in my opinion. Now, what does that mean for us? Well, what that did here, if we can take a look at the data, and just say, oh, well, how did that affect the market? And then you would go here and go 945. All right, well, that seemed to affect the market pretty well, right? Like you could see how that would affect the market. And again, what moved the market? And this is I'm going to hammer this home because I really want people to get this, right? What moved the market was the 8:30 data and the 10 o'clock data. That's what moved the market. It wasn't some guy saying, we hit this technical indicator and went from there. Let me move this exact so you can see it. And what happened is bonds were bought, the dollar sold off, and equities rallied. The exact opposite of what happened here. And so what this did was it whipsawed people. And we need to talk about this because right now the S&P and the Nasdaq have a control bar. And now we have to tie this whole thing together. And you're going to get this in a minute and why this line's so important. So if you take a look at how you're set up right here, right, we know that hot data, super hot data led to bonds selling off, dollar rallying, equities down. We know that data that was more in line with what we would like to see, which is either no rate cuts, no rate cuts, no rate hikes is much better than a rate hike. We would all agree. And I'm not saying they are going to hike, but now it's on the table. And so now if we look at this very clearly, we can see a reversal from here. But wait, there's more. What I've done on this chart, and anybody can do this chart. You can save it for free. I am on TradingView. People ask all the time. It's under Arete. No, that's not my name. And it's ARETE 20706. Okay, as I stated, but wait, there's more. So I'm going to take the dollar out. I'm going to leave the S&P and I drop the Nasdaq in. And then what we're going to do too is let's take out and hide this for a moment. And what you're going to notice is see how the S&P did not get back to where it was from that date at 10 o'clock. And then if we come here, look at where the Nasdaq is and look how the Nasdaq came back. That's really significant. So what we're saying is we're seeing a rotation back to these levels. Now, are you at that 930 peak? No. But are you over this 945 peak? So let's just, hopefully you get what I'm putting down. Please comment if you get this. Sometimes people will say, I'm trying to be like very specific so that people get it. But if you were to say what happened at 945, you would say the Nasdaq retested that level and held. And you would say that the S&P did not retest that level and was unable to lift there. So when you look at that, and then we tie all this back to looking at the ES and understanding that that's a doji and that the NQ is here hitting all-time highs, if you were an investor and you were looking to take action next week in trading, which names would you be looking at? Now let's tie it all together. In front of us is the New York Stock Exchange Zweig breadth thrust. And for those that watched the previous video on May 12th, remember I talked about how it was created by a gentleman that used to live at the top of the Pierre Hotel in New York. So you probably want to pay attention to this versus somebody like Freddie Fingers on Twitter. Now, the breadth thrust indicator is a technical indicator used to ascertain market momentum. This is exactly from Investopedia. For those that are newer, if you do not know something and you hear me mention something like, hey, this is a moving average, some of the concepts that go through here for beginners, if they get lost, go to Investopedia and just look up the definition. It's very simple. And they're fairly accurate. So just FYI. Divided by the total number of issues. So what you're doing is you're taking the advancing issues on New York Stock Exchange. You can do it with the Nasdaq too. Doesn't really matter. Divide the total number of issues, advanced plus decline on it, and generating a 10-day moving average of this percentage. The indicator signals the start of a potential new market when it moves from below 40, right, completely oversold, and then just goes wham to 61.5 within any 10-day period. The important part of this is the 10-day period. This is extremely rare, but it does happen, but it's extremely rare. So when we know that, and this is what they call it, there's only been 14 real ones since 1945. So if you're waiting for that, we're going to grow mold. But there's still value in it, right? And so the value to this and what we went over on May 12th, and you're going to be like, why are you tying this together? You're going to see in a minute. So here we are down, and then we did it, but we didn't do it in 10 days. So the purpose of me explaining this was, yes, I understand that we didn't do it in 10 days, so we don't technically have it. But you can use this indicator in these levels, for example, down here. And if you did something as simplistic as, oh, well, let's just mark this off to here, and did that mark a bottom? From here to here, did that mark a bottom? And then you would just come here and say, well, did it or did it not, right? And then you might see something that kind of looks like this. where, oh, you might be marking a bottom, okay? Because it did it here and here and here. And what you're looking for is the undercut, right? And then from the undercut, you're looking from there to the overcut, right? And then going, oh, okay. So maybe this is something that we want to pay attention to, and you would just kind of go through it and see that. Of course, this one's going to be there, but this didn't even happen in 10 days. So am I supposed to not pay attention to that? Hopefully you see where I'm going with this. What you have in front of you is something that is telling you that we've gone from oversold to overbought in such a short period of time that they have flipped from net selling to net buying really fast. Not within 10 days to get a specific one, but you're darn close to it. I think you did it in 14 days. So we wanted to pay attention to this because this is explaining the force of movement that you're seeing in the market. We're going to tie this all together. The force of the movement that you're seeing is also coming by people increasing the amount of money that they are betting with. For example, you have more people betting with money now on margin than any time since January 22. So as the market was dropping, you can see these peaks and valleys, right? What was happening? Market's dropping, they're getting out. Market's going higher, they're margining. They're now more margined than any time between here, January 22nd, and what started here. Okay, so are we going to see this decline here? Let's change that color up. Are we going to see that decline here? Well, we're not declining. Or are we going to see a rise like we did here? And what would that rise mean? So there are two factors for what's going on under the hood right now. The first factor that we just went over is the oversold to overbought. And then at the same time that that's going on, more money is piling into the market, whether it's through cash that's on the sidelines, which we could have a whole debate about that, or it's just people using margin. And that margin is also how those companies are making money. We went through that a week ago. But more importantly, this means that there's more behind it to push supply and demand. If you tie that to what you're also seeing with the Nasdaq, so this is part of a video that I put out weekly, and if you're in the community, you're going to see it. But this explains it in great detail. I went through it last week. Take a look at this. In front of you is the TRINQ. The TRINQ, you can get this from Stock Charts if you have Stock Charts and you pay for the service. Some other services have it, but it's not as good. So I'm just going to show you it. And this is the way I'm showing it's pretty much the cheapest way that you're going to find it. Now, the reason I'm showing this, because it's a short-term indicator. This is how it's calculated, just for those that care. You take advanced decline, right? So you take the advanced issues divided by the declining issues, you're going to get a ratio. And then you divide that by the advancing declining volume. Anything over a 1 is bearish. Anything under a 1 is bullish. All right. It is a short-term trading indicator, but it marks levels. And that's the important thing about it. What we can see right here is that we had a 1.6. This is not common. Okay. And what this means is that you have a huge out of whack group and you have massive buying. And you can see these levels. I'm going to mark these on the charts where these other readings were. So while it doesn't look like you have massive buying under the hood, like this is the internal stuff that you can't see, but under the hood, you have massive buying. You've had this reading 5 times, only 5 times. So what I'm going to do, and again, I'm going to try to keep this short, sweet, but this is something I really didn't want to get into in the public video. That's why I always tell people if you're limited on time, you watch the private videos. That was the first time, okay, in 20 something years. It's actually going back. That was the first one. That led to a bottom that we rallied, came up, and then we halted, and then we started to get weaker, and then we all know what happened. And we all know what happened. Okay, so if we could see this and we understand this, it's important for us to get this, right? But that's what happened. We bounced off that level, and it gave us, in a massive decline, it gave us a bounce, and that bounce from here, if we just look at it, okay, that was not a small bounce in the Nasdaq at all. Not even remotely a small bounce, okay? It looks smaller, but it was about 44%. This time, essentially, you went up a little higher from that low, from here to here. Okay, it was about 26%, and it literally marked the bottom of the market, right along with the Gulf War, tying it directly into it, a retest, and then that was it, and you ripped. This was during the great financial crisis. That actually marked the bottom, and then you can see we retested that level. It's important to get this. We rallied, and then months or a year later, we retested that level. So that gave us about 26%, and then we retested that level about a year later, and then we ripped from there, okay? It's not a be-all, end-all. We still went lower here a couple of years later, but you did rip for a period of time. If you look right in here, same exact thing, and that marked the bottom. If we look at the most recent event when this happened, it would put us right here, and then it happened on Friday, okay? You don't sleep on this. You don't see it very often. It doesn't mean that you go out there and you go nuts and go, we're going to buy everything. It just is one indicator. but it is extremely rare to see. When you start seeing this kind of stuff, and the week before you start seeing the Zweig breadth thrust, which we went over, if you're not reading the tea leaves and you're not leaning long on these pullbacks, until this settles out, I don't know what to tell you. It doesn't mean 6 months from now or in 2025, we can't fall off a cliff because they didn't handle inflation. It means right now, this week, you need to be aware of that, especially when you have a market that's hitting all-time highs. What some people have asked in the comments is just a recap as we go along. And one of the things you can always do with these videos, you can always just click the share button for yourself. And then what will happen is a little pop-up will show up, and then just click on the pop-up, and then you can actually timestamp spots in the video and just save the link. So I can actually show you how to do this in another video, but it's really simple. You just click the share button, and then after that, you just click on the pop-up, and it'll have a timestamp, and you just click that, and then just save that link, and then you can come back to these anytime. So if you're trying to find something that's in these videos or in previous videos, if you save those links and timestamps, you can just go right to it. Now, what I want to do is a recap because I keep getting asked about these. And so this is where we're at right now and what we've done. We've gone over the mixed economic data and how that's affecting the volatility. We've talked about the TRINQ, which you just watched, and how that's affecting the Nasdaq and how significant that is. Then we talked about reviewing what happened on May 12th, which is the Zweig breadth thrust, okay? We reviewed that you have massive leverage in the market right now. We've reviewed that the Nasdaq is leading and that you have financials and semiconductors leading, which we have not touched on yet, because what we want to do now is show how this is affecting us actionably in the market. So I'm going to review a trade here so that you can see how you're supposed to be trading in this current environment. I think this is pretty significant, so stay with me. And what we always want to look for is confirmation. So XLK, XLP. Why am I showing this? This is technology divided by consumer staples. And what this always tells us is exactly what's going on. So if we look at a market and we get to a point like this, where we're seeing, like we saw in April, and we're falling off a cliff, that means people are buying defensive names and selling tech. They are buying defensive names and they are selling tech. Well, we just got to this support level and we kept bonking our way out. And now what are we doing? We're setting up at the high end of that range. Does that mean that we're going to break through it? I don't know the answer to that. And quite frankly, no one does. It's like me giving you lottery numbers. But what I can say is with the breadth behind us, the trend that's behind us, which shows massive buying, the fact that you're seeing the earnings coming out the way that they do and what's leading, I would think there's a high degree of probability that this continues. But now the question becomes, how do you trade this market? Let's take a look. All right, so I'm going to give an update to the account. Now, for those that are newer, this is an account that is linked to the ideas that I do in the trading room. And what's important about this is it really gets through a bunch of misnomers. I get asked what this account started with. If you go back and start looking from January, I think we started with, I think it was $1.60 or something like that in this account. To be clear, this is not how I trade all my accounts. I compartmentalize my accounts by trading style. It just works for me, meaning long-term trades are in an account that is geared towards long-term trading. This account is run and gun. In other words, I'm being very aggressive. I'm being very aggressive with my trading, and it is geared towards day trading and short-term trading that we do in the community. Now, there's a couple of things about this that are very important if you're newer that I really want to point out. On something like this is my trade expectancy. So these are things that if you're trying to trade, you should know, like you should be able to rattle them off immediately. Like if you're like, I want to do this full time. You should be able to rattle these off, point blank. If you don't have data, you can't measure anything. If you can't measure anything, you don't know what your results are. It's really that simple. If you just boil it down to that, it's very that simple. You know, results, anything that you measure, you'll get results on because you have a data set to work off of. I'm very big with that. And I've seen it work over years anyway. So what's important about this is people will go and look at this, but understand where it's coming from and understand the style of trading that's involved with this. Not everybody's going to do the kind of trading that I'm doing in here or be this aggressive, nor am I this aggressive with everything. This is one style that has worked in the community that we're doing, and I just want to link to it so that you could see what we're doing. The important thing is not this. The important thing is the trade expectancy. Every time I put on a trade, people would look at this and go, wow, that account's worth X, and now you're in a position here where that's all you're making every time you touch the computer, right? Like that's your trade expectancy, right? Every time you make a trade. It's very different than how people view it, right? But also I'm scaling out of my trades. So that's why it looks that way. I'm not all or none. So like every time you press the button, you're going to scale out more, right? So if you're scaling out 5 times, then and on a $1,000 trade, it's going to read that way. But it's important to get that concept because you should be scaling out, especially if you're short-term trading. It shouldn't be all or none. Profit factor, 1.79, right? I want to get that as close to 2 as possible. Okay. Win rate, 54%. No. If someone tells you they have a 90% win rate, run away screaming. Okay. Maybe they could do it for a month. Maybe they could do it for 2 months. It can happen. You can have a really good period where you're just killing it. Historically, the guys that are out there, the Steve Cohens of the world that are billionaires, Simons, who just died, Simons was at 51% over 30 years. All right. So I already know like this is the reason that his are going to be like that and mine's actually going to be higher is because I'm dealing with significantly less money. It's very hard as you get bigger and bigger to turn the ship and have a high win rate. It just is, right? The more money, the lower the win rate. It's just harder to turn. And then this is your win-loss, and really what you're shooting for is a 2. Now, what's important about these concepts is how the market's changing. So if I went here, for example, and I look at this is year to date, and I go to May, for example, or let's take April for a second. Actually, let's take March, because March is a much better example. March, here's my win rate. Here's my trade expectancy. Right, this is what we did in March. See what my win rate was? I wasn't even at a level of 50%, and I was still up, right? And I had an oversized trade, but it's not as oversized as you think it is because it was bought the day before and then et cetera, just the way that they account balance. But the purpose of this is understand that your win rate sometimes is not even going to be 50%. So that's when you dial it back, and you can see all the chop in here, right? Like how choppy April was for me, or March was for me, I'm sorry. But then you start getting into April, okay, and you can start seeing it pick up again. Now, when that starts picking up, you look at the difference in P&L versus it, but the win rate's higher. And I would much rather have this because this is way more consistent to manage. But what we're doing in April is look at the profit factor, right? Because April was a tough trading month. I don't think anyone would disagree that April was a tough month to trade, right? But what you're looking for with your data, and this is when you measure it, this is how you get results out of it. When you start to see turns, you can see how many like bad hits we had. They were the worst hits I had, I think, all year in this account. But then you start getting into May. Now, this is not up to date because I believe that, Friday's not in here at the time of recording this. So all the NVDA trades are not going to be in here for people that are in the community who know that we had a bunch of calls and a bunch of stock. Whatever. Anyway, so this is where it gets really fascinating to me because I am a nerd with this. And I did have an oversized trade in AMC in here where we just killed it on some calls. And I did have an oversized trade as well in some other puts. But overall, look at the consistency as the month has moved on. That's what I'm always looking for. I'm looking for that consistency. And by doing the same kind of tradings and being consistent, right, doing the same kind of style, you're going to note the consistency. That which gets measured gets results. So then you're going to go, oh, my style of trading or this style of trading, you develop different processes as you get better and better at this. This style of trading is working now. So now the win rate's at 57%, which is, I have to understand, is very high. The trade expectancy is 457.08. So what's that mean? I'm way above average, right? So what does this data tell me about this kind of market? This kind of market is telling you that you should be pressing your bets, which is very different than what we saw in April. And there's a couple disclaimers with this, but we'll get to it. But it does affect your trading. And that leads us to this trade review that I want to walk through with you. But when I start to see this and I have outsized win rates, my profit factor should always try to be around here. And my trade expectancy is like double what the average is. For example, if I go here and take a look at that and go here, watch, I go to January and then go here. And these are not that crazy of concepts, guys. But when I see something like this and my win rate's up, right, I have to look at this and go, okay, if that's what's happening, this is when you press your bets. You have to understand you're going to see more significant moves. And this ties directly into what we just went over. See how it's all tied together? Now you're like, well, now I understand why I'm looking at the Zweig breadth thrust. Now I understand why he's looking at the TRINQ. Now I understand why he's looking for what sectors are outperforming. And that affects your trading. Let me show you this. Let me show you this trade. Now, what we're seeing here is a very simple trade that we did on CEG, and you're going to watch it live in a moment. The importance of showing it live, to me, is because everyone can look at a chart and say, oh, this is what you do. You buy down here, and then when it breaks, you just hold it, and then the retest, you add to it. And then, that's great. But to see it live is exactly what you want because that's what happens, right? It's very easy to use hindsight. It's much different when you're in the throes of it and you're dealing with something like this and going, okay, what am I supposed to do here? And you're watching the thing play out. For us, all we were doing was just waiting for an orb. Now, an orb is an opening range breakout trade. So Opening range breakout. What happens is you establish a range within the first minute or two. You can use any time frame. You could use a 5-minute time frame, which is really what I did because I was afraid of just the shake and bake off the open, especially on Friday with the light volume. But once I have a doji here and I'm set up this way, what this is doing for me is this is telling me that we know that wicks are what? Price rejection. See how all this ties together, all these lessons and all these videos, they all tie together, right? It's just wash, rinse, repeat. So, okay, so we know wicks are price rejection. So that tells us we have no what? Sellers down here, and then we flip the hammer. I like hammers better than even like long green bars because it means that I've got nothing here to even stop me. Then we flip and then we go. Once we flip and go, that was it. It was on like Donkey Kong, if the kids still say that. And what we're doing is we know by the data that I just showed you and all those other indicators, we know that we're in a hot market, meaning that this market has the potential to go higher. We know that through the analysis of our journaling, which I would suggest whether you use TradeZilla, TradingView, TraderSync, I don't care who you use. I don't care if you do it, old school. When I used to work with people like before all these other journaling systems, I would have them literally, we'd do a spreadsheet. I actually did a whole video on a spreadsheet that I created. And I think it's better to have it autoed because then you just can look at it and just assess the data. Make sure, and it gets done because sometimes you're just going to forget because you have a life. But when you flip up here, we're pushing. So we know based upon what's going on in all those indicators that we're in a market that can continually to press. For how long, we don't know, but we know that it can press. And we saw this in some other names. Now, let me just show you this so that you can get this. So while I'm live trading, and you can see that live trade, give me 1 second to trap this in. And again, I'm not going to edit these out because quite frankly, I don't have the time. I'm doing too much prep on the videos to put them together to spend the time to edit. But this is John. Everyone say hi, John. John's typing in the room while I'm live trading because I can't type at the same time. I'm not that good. So what he's doing is AT is buying something here. That's brilliant, isn't it? So what we're seeing, thanks, John. So what we're seeing here is I did an FSLR trade and I could show you these charts and we bought cost as well and CEG as well. But I wanted to get involved with these names and I'll cover this on Monday as to what names I'm looking at and why. I actually create my own sectors, but what I want to show you is this. I want to show you the trade. Let me just stay on point. So what we're doing with the trade is just letting it play out, right? That's all we're doing here. And what I'm doing with it is I'm just scaling out into it. I mean, I'm pulling money out. But if you listen to what I'm saying, I'm being very clear that I'm going to let these run a little bit longer. So before, in April, what I would do is I might just go, oh, I popped. Oh, I'm up $3-4. Oh, I'm going to take it. Now it is benefiting people to hold these kinds of trades longer. And by holding them longer, they're able to capture more money. And the reason for that is because of all the factors that we just went through. So I hope that makes sense. And I hope you can tie that all together. Let's watch this live and then let's focus on what we're supposed to do the week ahead. That's a real nice tight stop on that trade, isn't it? I mean, it's almost perfect, isn't it? It's only $1. Oh boy. I like that. All right, let's see what we got here. All right, I'm going to buy CEG. I'll tell you exactly what I'm going to do with it. Once this bar forms, that's going to be my stop on 60% of it, 65% of it. That's going to be my stop on the other third, okay? And maybe I'll hold it over the weekend. And I do like when I have wicks like this to the downside because that means I have lack of selling. Up in this, what are we up, $1? Okay, very little to do there. I really don't know that I'm going to do much with it. If you're day trading it, you want to pull money out as the trade works for you, right? We know this. I'm up about $1.75. CEG, I'm not really doing anything with. I think I'm up 3.5. I might hold it overnight. And the CEG is doing what I need it to do. We had all-time highs yet? Good, all-time highs. Nothing for me to do. So the CEG I'm going to hold, it looks like. Sometimes that's going to happen, guys. And for day trades will become swing trades for me. 230 looks like a roadblock on CEG. So you're probably just going to want to watch that. If you're doing this for the day trade and you're up 5 and you're not taking money out, I can't help you. Whoa. Oh, everyone's high-fiving their bros right now. Here you go, guys. Trimmed up 8, I guess. Give me another one. Give me another one. I'll feed the ducks all day long. Give me another one. I sold up to half of that position if you're trying to figure it out. So I'm half out of that now. It moved way more than I thought it would. I mean, I literally just bought it, not even a half hour ago. And I'm up $10. Like, that's a no-brainer for me. Just bring the register. Now, I still have half and I like it, but if I come down to 227, I can add to it. Now, I hope you found that helpful. I know seeing the clarity of that, it's not the best because of the way I cut it out, but it is what it is. But what I want people to get from that is it's really important to see it live. When you look at CEG and you see what's going on there, we love these names, right? All the AI power names, power for everyone. Now we're going to all have like solar again. So you might want to start watching the solar names. We had a really great trade in FSLR. We had 3 really great trades in this week. We had one where we went long. One I actually went short on puts, and we actually made money, shockingly. And then I saw this break on Friday, and we did this trade as well. And it did well. I did not capture the entire move. They did much better. Some guys did much better in the community with the move than I did. I was just popping out on these rips. But this was pretty clear that we were going to go. And we can get into it later. But this is what I'm talking about. People are going to start seeing these kinds of moves, and they're not going to understand why, right? FLNC was another one, okay, that is out there. There's very specific names that are moving like this. And what people are starting to realize is, oh, they're going to equate to all of them. It's not all of them. It's a very specific group. I'm not saying they all can't lift, but there's very specific names that are being touted by investment banks. And when you start to dig into that research and start pulling it apart, I'm moving my hands around and you're not going to be able to see that, but I'm Italian, so there goes the hands. But what you want to see here is you want to find out, you want to identify those names. If you don't have access to the research, which a lot of people do not have access to all the research, and I get it, how do you know? Start looking at volume spikes, above average volume spikes over the 50-day. How do you know? Start looking for above average volume spikes above the 50-day and start measuring them like that. So in other words, if you look at ENPH, did ENPH have that kind of volume spike? It did not. Did FLNC have that kind of volume spike? You can actually even create a program that will tell you how high you are. Are you 2R off? Are you 3R off, right? Those lines, okay? You can actually create those. They're very helpful. How about First Solar? Okay, so which ones do you think investment banks are touting right now, right? Do you think there's certain specific names? There might be 2 that begin with an F. Okay, these are names that we've been talking about for some time in the community. Those guys know it, but you see where I'm going with this? If you don't have access to the research, you have to use what you have. And so the way to do that is to just, the way that I would do it in the past, if I went to see something, just put a 50 there and then just look, am I 2X over it, 3X over it? That'll tell you what the institutions are buying. They can only mask what they're doing for so long. So then you have solar. So that probably pulls up solar because now we're going to need power, right? And so you could always just look at the trade and do it that way. But there's some dichotomy that's going on here that we should talk about. So like take XLF and the fact that, we're right at that 55. And then you have JP Morgan coming out and saying, by the way, yeah, I wouldn't buy my stock here. Like, what CEO says that? The only CEO that says that is the one that wants to buy a stock, right? And this is an important concept that I'm not going to get into in this video for time's sake, but I think I'm going to cover it on Monday. Drop it in the comments if you want me to cover it. But you have to understand, you do what they do. You don't do what they say. So when someone like on NVIDIA, for example, when he's coming out here and Druckenmiller's like, oh, I'm getting out. Okay, he got out and he might have gotten back in. You don't know that. But when you start to see the dots connected, I'm going to connect these dots on Monday, the more I'm thinking about it. Drop it if you want to see how this is done, because it's more of an advanced technique, but you have to learn how to read news and what's going. You want to do what they're doing, not what they're saying. All right, so it's very clear that at the end of the day that this was, let's get the stock down to a reasonable price. We'll step in, we'll start buying more, and we'll go from there. And that's exactly what happened here at JP Morgan. But what I want you to get are these concepts, because these are very important concepts. The market cannot sustain a bull market without financials. If we lose financials, we have a problem. On Thursday, that was a red flag to me. It was not a yellow flag, that data. That was a red flag. That scared me, that data. And you can go back to the beginning and look at it. Then you have the SOX. So what do we have here? We need the SOX to lead, and we need the financials to lead. So I'll say that again, for any bull market to sustain itself, and I'm not smart enough to know when this is going to end. People in the comments are always much smarter than me. But if I look at the SOX, that looks like a fairly decent chart. But I have a control bar here that I've had here before and I rejected. So to ignore that would be foolish, right? So what we would want to do is go look at names that have already broken out above this. They might be names that you might want to focus on. It is impossible for financials to go down and the market to sustain itself. What we have to be cognizant of is, yes, Thursday we did this. Yes, Friday we did this, but there's no volume on Friday in the financials. If we take a look at the SOX, you have more volume, but nowhere near what you had on Thursday. So that could mean 2 things, okay? That could mean that we were able to go up on very light volume, which means what? Sellers are exhausted, right? So if you go up on half the volume, people will be like, oh, we didn't break out on volume. What that really could mean is that those sellers, the people that sold, they're exhausted already. And sometimes you see selling exhaustion as a peak, right? You want to understand that when you spike up on exhaustion, on selling, sometimes it's a peak. Sometimes it's not, but sometimes it's a peak. of selling, right? So you always want to watch that. Usually it's congruent of a couple times together than one. And usually it's not at the top of a chart. It's at the bottom, right? And that's very different here than what we're seeing. But that held us. And I think that's an important note. Same thing here. Now, if we take this out and we tie this all back to where we started, that puts us right here with this control bar. So do I think that we're out of the woods? No, I don't think we're out of the woods. What I would suggest is looking at the SPY and going, that is a control bar. So this is the easy concept for you to get that is actionable, for you to mark that off and go, that's a control bar, whether you agree with me or not, right? And just say, I need to get over 533 and just watch how the market acts on these bars. Because just like that's a control bar, this was a control bar at the high. And they are control bars until resistance becomes what? Support. So we would know that that 533 is a level that we must pay attention to. We would know that that 524.10 is a level that you must pay attention to. So again, I'm giving you numbers because sometimes people drive and listen to me. So I'm going to start trying to remember to do more of that. Let's take a look at the Qs. And we know this difference already, but we can always discern difference by simply dropping a line on a Fibonacci level, going into settings and get rid of the 0 and all the other fib levels and just leaving that 50% and on there and then going, okay, well that 50% line is 456.84. So I'm already 50% over that bar. And what does that tell you? It tells you who's in charge now of that bar. Buyers are in control because I'm over the 50% line. And then if I go here, and these are just demarcation lines. This is how I view it. You don't have to view it that way. Some people would argue with me. And that's okay. But this would tell you as well that, okay, well, you're at that 529.25 level here for 50%. You closed at 529.44. So you're in line to over, right, is how you would look at that. But we would argue again that Friday that the Qs performed better. So tying everything that we went over, what would you do with all this information? You would go out there and look for the names that are moving and hitting highs that are in the Nasdaq. And then you would consider holding them for longer periods of time because those trades are working better than they've been in the past. And we saw that by the trade expectancy and the data. See how all this ties together? We're bringing it all home. So, and this is because of your comments. So I greatly appreciate them. And if you are on the wait list to get into the room, I will be able to set out a batch of them this weekend. I will have the time. And I apologize for not getting them out sooner, but it is what it is. I talk to everybody that enters the community or at least gives them the opportunity. So it's an actual community. So like you see how you're sitting right here on NVIDIA. And this is the important thing about NVIDIA. See how you're wedged in here? See how this wick encompasses this? Wicks are what? Price rejection. Okay. So what does that tell you? That tells you that everybody here on NVIDIA sold because even though this is green, you still had sellers. You don't know that they're done. See how that wick here and that's all done in here? They're all gone. Those sellers are dried up. Where'd you close? At the high. So everybody that was selling in here is gone, right? They're all what? They're gone. All you have are buyers down here now. Now, it doesn't always hold, but understand the concept, right? So all you have are buyers now. So where you dried up and it didn't have buyers on Thursday, Friday you have buyers. Where you had sellers, you don't have sellers. It doesn't really get more bullish of a two combination than this. I don't really know why that's not even a candlestick pattern, to be honest with you. Maybe I'll call it a candlestick pattern and we'll make it one. I don't even know how I just did that, but let's clean this off again and drop this down. So hopefully you're getting this concept. This is big. Let's take a look at it on a weekly. Okay, does that look like something that you don't want to be in, right? That's week one. And we'll get into this and the misnomer that this is priced too high. When you're growing 100% and you're $1 trillion company, and your PE is 30 because you're going to earn 40 next year, it puts you at 1,200 just off of that. Okay, so I'll pay 30 times earnings for 100% growth every day of the week, and we'll all look at where our portfolios are at the end of a year. But nonetheless, this is going to be a slow grind, and people are going to I'm not going to buy that anymore. A lot of the people in the community right now have been trading this, and they're killing it with it. The NVDA, it's much easier to trade. It's much smaller. Some people are even buying calls on it. You could take a look at that. You could just short the heck out of this, which is always fun. But, okay, so I don't want to do these trades because I just don't like them. So then you would have to go out there and say, well, what's hitting highs that you could look at besides those? And how you must look at this market, please listen to this. You have to be top down. So you have to go index, which takes you to the Qs. Then you have to go sector, which takes you to semiconductors. And then you'd have to go names. Okay, these are your leaders. You could go into the XLK as well, right? And say, okay, well, I want to play the XLK names because they broke out. But that doesn't take you into the index. Right? So then you're out here buying Apple and wondering why you're not hitting highs, right? Microsoft, right? Why are you not breaking out? Why are you not hitting highs? You're tied to the XLK, you're tied to the S&P more than you're tied to the Nasdaq. Please understand that. Not saying that they can't go, but what's going? Well, the stocks, but you're not hitting highs. But names in the stocks are. So what you would do is cycle through those names and go, okay, well, how about the semiconductor equipment manufacturers? Are they breaking out? Well, not yet. Okay, even Lam Research is not breaking out. So you just want to keep cycling through them until you find something. You would go look at AMD, which I have been shorting. I shorted Friday, it didn't work well. And you can't possibly even consider looking at this until you're over the 55, which it probably does. A rising tide lifts all boats. But what you're looking for is outperformance, correct? You could start cycling through names that are capital equipment manufacturers. You could cycle through any of the names out there and see what you could find. I would be looking for stocks that are breaking out, like VECO, and understanding that these could move higher than we thought they could, right? Hopefully you're getting how this all ties together. And then Qualcomm, which we had to trade on, and I didn't want to hold too much of it going into earnings, and we were up considerably, so I got out of the way. I was concerned about just NVIDIA because you never know. But we were up like 10, 12 bucks on it, so we just took it. But that's a breakout. I'd like a retest of that level, the 193.75 level. But I'm still waiting for Giselle to call, and neither has happened. So I don't know that I'm going to get that, specifically with the way I'm telling you that you're seeing the momentum and you're seeing the shift, right? Look at Taiwan Semi. All right, so there's just three names just out of it. So you have Taiwan Semi that's hitting all-time highs. You have Qualcomm that's hitting all-time highs. VECO. Cycle through the capital equipment manufacturers, and you'll find all names like this that are starting to break out, that make this little widget or that little widget. I mean, it is very clear you're going to need more DRAM, right? We're going to need more power, and we're going to get to that as well in another video. But by cycling through these names, you'll be able to find this. Also, the other thing that's really fascinating about the market, and I want to touch base on this, and this is not an antithesis trade, but a trade that I think is telling you more about the economy. If we take a look and we look at XLY, it looks absolutely awful. You take a look at Amazon and it looks god awful, right? I had a trade on this and that trade did not work. I think it's really important for me to keep stating win rate over and over again, because I think people that are telling you how easy this is and they're trading from a mountaintop or a pool and they're pressing a button, I think they're doing people a disservice, because people don't understand how hard this is to learn as a skill set, right? And there's stages to learning the skill set, but another video for another time. But I really think they're doing people a disservice. I don't think I think they're trying to sell something, obviously, but I think what you have to think about is, to me, I don't think they realize how much damage they're actually doing to people who think like, well, all I'm waiting for to happen is this to cross this, then I'm supposed to do this. It doesn't work that way, right? Hopefully you get those concepts. When you look at this and you see how it's acting, you would think that XLY is dead, but what we're seeing are the specialty names like Ross Stores, right? Williams and Sonoma, right? Look at these reversals. Look at this stuff. Like, these are massive, massive moves. Now, this is what's interesting about something like Williams and Sonoma. Look at that bar down on Williams and Sonoma, and then you just stopped. Like, why would you just stop there if there was going to be more selling? You literally just came into an area, right? We're seeing a massive shift in these names. Look at ELF, and look at that break, and then look at how you acted on Friday. Watch Ralph Lauren. So why are these names acting like this? Why are they getting back above their 55 if we're in such bad shape? Why is Abercrombie & Fitch breaking out to all-time highs, right, if the economy is in such bad shape? It seems like we're going back into the specialty retailers. Now, you have a couple other names that are going to come out with earnings, and I thought this was interesting and worth pointing out to people. Look at the little turn in Ulta. So if you were short, and you were short retail right now, and you saw this happen to ELF after they downgraded earnings, and Ralph Lauren that basically said things aren't as great as we're supposed to be. This is a really important concept for next week. Why would you stay short this? I would be able to sleep. I'd be worried. And I know that, the ladies love their special pants, but they stopped buying them, right? But all of a sudden, for the past 2 days, all of a sudden, Lulu is going sideways here. So maybe looking at these names and trying to understand what's going on there as Walmart comes out and hits all-time highs, but they're selling Target. And that selling lasted how long? Didn't even last a day, right? So when you start connecting these dots, it starts to get really clear. Apparently DEC, everybody wants something that DEC sells. So again, connecting the dots. The consumer, for whatever reason, is getting stronger. For me to start looking broad-based at the sector, I'd want to see more action on the XLY. But to get into the specificity of the names and the companies, it is very clear. Names like ON, which is pretty much like, they're like my favorite brand of sneaker right now. When you start to connect all these dots, this is really clear what's going on out there. And so I would not sleep on this and what it's saying about the consumer, but more on that on Monday. That's it.